All attendees are in listen-only mode.
Well, the Fed did as expected, and it was a relief to some of the participants that were concerned that they would be more aggressive than hiking. First of all, they only hiked 25 basis points. There was some speculation they might do 50, and then there was speculation that for the rest of this year they might want to hike more than 3 times. But there were no surprises, and that was interpreted as a relief and also bullish, since the Fed pretty much said what the market wanted to hear as far as the economy going forward. And there has been some speculation that because Donald Trump has questioned the existence of the Fed and why do we need central banks, and the Fed may have a self-preservation mechanism in place that is to attempt to make the Trump administration look bad by intentionally being too aggressive in terms of their rate hikes, and basically catalyze a market crash of some sort, because obviously everything's very fragile. And I think that fragility is keeping in context with history, because when central banks print as much money as they have, and this is a global phenomenon, there's never been a way to unwind all the debt. Generally speaking, everything's connected, and when one topples, it's a domino effect. And we saw a preliminary version of that in 2008, and now things are even much more extreme, because in 2008 the interest rates were not at historically low levels, so there was still room in the gas tank, or let's just say there was headroom to reduce rates to trigger some sort of economic salvation, and obviously to trigger the beginning of the bull market, which began in 2009, which is continuing now. This is the 8th year of this bull market, or 9th year rather. And of course, the historians out there will point to the rise and fall of Rome 2 millenniums ago, and that of course took apart everything. But there's other examples as well, not just the most famous one, of money printing gone wrong, and often it's usually contained to a specific country. But when money printing becomes a global phenomenon, as it has over the last several years, the result's never been a soft landing, and countries are mired in massive debt burdens, and that includes China. I think there's a misunderstanding that China's sitting on trillions of credit, but actually their debt to GDP is at all-time highs. So although I would say that they're better off than other countries, certainly, but nevertheless, everything's pretty connected, and the world is in massive amounts of debt. Interest rates, of course, have been at all-time historical lows. So there's not a whole lot of ammo left first of all, to further reduce rates to spark any sort of economic recovery, especially if the current recovery starts to falter. In other words, if we start to trigger a recession of some sort, what are we going to do? What are the central banks going to do? They don't have a whole lot of ammo left. They've painted themselves into a nasty little corner with no choice but to continue to print money to keep things afloat. And we all know who Bill Gross is. He used to run the largest bond fund, and he wrote about 2 months ago in his monthly report. He mentioned that while the U.S. of course ended its QE programs, the ECB and the Bank of Japan continue to print because they really have no choice. If he writes that if they were to end their QE programs, it would be the start of a serious bear market. So they continue to print, although they've given indication that they want to print less, or let's just say not accelerate the amount of printing they've been doing. But that's a tightrope there. I think things are on thin ice, and the Trump rally, of course, kind of masks that. Trump has some programs in place that will be good for the economy. The question remains still how quickly he can get those into place, and whether that's enough to create some sort of soft landing. Again, that's never been achieved. We've never achieved a soft landing when we're in this much debt. And indeed, the number of luminaries out there. We've got legendary futures trader Ed Seykota, who wrote his book Gavopoly in the 39th Day. You've got Jim Rogers, you've got Bill Gross, you've got Martin Armstrong. I mean, there's a whole list of these people with great, the track records speak for themselves, and they've all said for the first time that I can remember that there's a massive price to pay for all this money that's been printed. And even the former head of the Federal Reserve, Alan Greenspan, has said that this will not end well in his classic understated manner. But all that said, trying to predict the market crash, it's a total futile exercise. And you got to watch your stocks. They're always going to tell you what to do. They will always get you to safety, barring a market gap down of a general market gap down of 30% overnight. They will, but I believe that if that were to happen, by the way, there would be signs prior to that. It wouldn't just happen overnight. You would have already seen some market damage done prior to such an event. At least that's the way it's always happened. That doesn't mean it has to always continue to happen that way. But the main point here is always watch your stocks, and they will guide you to safety. And that's why whenever you put on a trade, make sure your stops are in place, because risk management is absolutely key, so you don't blow up your account and you live to trade another day. And we all know that robust strategies should not just be Six Sigma robust. They should, I would argue, they should be out to 12 Sigma, which is essentially saying that you should be able to trade the strategy for 100 lifetimes without ever having a blow up in your account. I want to talk about just a couple stocks. That QTNA, we mentioned that one yesterday, or rather in the morning report, and it had been setting up a nice little voodoo structure where the volume dries up, and it was off to the races today. And I noticed that it eventually hit 10%, 12%, and it was up almost 14%. You got to take your profits. It's a perfect gift, and we saw the Amiop do that twice. And, again, I know the pattern looks great, and it looks like it's going to want to go higher, and eventually hit 30, which it very, very well may do. But on a time value basis, when you have that much profit in a name, you just take it off the table. And then, you could have just been, buy it back here. How much is it up right now? It's up about 7%. You could certainly buy it back at this level. It might end up closing mid-bar or something like that. But, and it looks good. It's doing everything right. The fundamentals are there. And the other stock, well, Amazon is incredibly tight here. What I like about the pattern is that your risk is just absolutely minimal. That would allow, it's a slow mover, but because the risk is so small, you could take a triple size position over your normal size position, so you can make it worth your while. Because if it does start to break out of this tight little formation, you'll probably get a few percent out of it. And then your downside, I'd use probably the 20-day. So right now, what is it? 1%. It's 20 days at 847. It's trading at 851. So your risk here is less than 1% in putting on a very big position. In the idea, that it will, move to the upside. Of course, that's market dependent, and we're in an uptrend. So, I suppose the odds are with Amazon, because they are also, if you look at the overall chart, they've been doing very well over the last few years. They're making great moves more recently in terms of being a contender against Netflix, and also the way they're expanding out their sales units. The Amazon Prime is a fantastic addition to what they've been doing, and they're of course getting into the groceries business. So they're trying to undercut other companies like Instacart, and they're trying to make themselves the place to go if you need to buy anything. Doesn't matter what it is, from jewelry to diamonds to groceries to ham sandwiches to delivery services, and I think they're doing it very well. I've used their services on a number of occasions. They even got guys that'll come out to your house to assemble furniture, whatever you need. It's there, and the price points are good, because there's a lot of people on board Amazon that are actually making their livelihoods by selling their services or their goods on that platform. So all that's to be said, I think the fundamentals are great on this company, and your risk right now is absolutely minimal. So it's a good opportunity. And with that, Gil and I can talk about some other stocks.
Yeah, the one thing about Amazon, though, that kind of bothers me is that it hasn't gone anywhere since it's broken out. So it's sitting here, and it seems tight, so we'll see what happens. But I think the whole story behind Amazon is pretty well known right now, and the biggest part of the business is the Amazon Web Services. So I guess if you bought it here, what are you saying, Dr.? You use the 20, yeah, the 20-day looks pretty tight. I mean, that's really tight. That's not even 0.5%. So yeah, I mean, or even the 10-day, it's holding the 10-day. We'll see. I don't know. You would think this thing would be moving higher because you've seen a lot of the other big stock NASDAQ names, like Facebook posted a pocket pivot yesterday, actually. But it's just steadily trending higher. And when you see something like this, of course, the 10-day line, I think, becomes your selling guide at this point. And the volume has been light on a weekly basis, so you wonder if you're going to see some sort of a crack to the downside. So it's kind of difficult to step in here and get aggressive, although I think maybe you could add here on the basis of the pocket pivot and use the 10-day line as a stop for that part of the position. So let's see, Netflix, that one finally, it was looking pretty grim last week. It looked like it might break down, but somebody came out, UBS Securities came out and raised their rating on the stock to hold from sell. So I guess when that happens, people interpret hold as buy, and the stock went up yesterday. You had a couple of 5-day pocket pivots, but it's stalling near the highs of this range, so I definitely wouldn't be looking at buying it here. I kind of look at this market, Dr. as still being in a bifurcated state, and there's a lot of names that have been nicely shortable. They're starting to bounce now, but Finisar is one. You know, that was a shortable gap down after earnings. X is really interesting because this thing is all over the place. It looked like death 3 days ago, or you know, it's rallying into the 50-day on light volume, and it just keeps going. So was there some news yesterday? Because I noticed Nucor, which is another steel, had a pocket pivot yesterday. It's gapped up today, and it's at the highs of its range. These stocks are really random. They tend to rally and break down almost on a whim. Steel Dynamics reversed nice, so that was a short. I don't know if anybody saw that, but you could have hit that today. I'm actually short a little bit of X right now into this morning's rally above 38, and it's starting to come in a little bit. But my thinking is it tends to do this. It moves beyond the moving averages in either direction and fakes you out. And eventually it could roll over if the market gets into some trouble. I have a great story from last Friday. If you guys remember, I think I was briefly talking about Mobileye as something that seemed to be weakening because every time it would get up above 47, someone would come in and hit it. So I kept shorting it there and just scalping profits. So on Friday, last Friday, I was short the stock. And it went down to, like, you know, I was getting about 70, 80 cents of profit on it on the downside, nothing huge, but like another scalp. And then it stops going down. I can feel the volume drying up, so the selling pressure kind of dissipates, and then it starts to turn around. So what I do is, and I'll do this a lot actually in something I'm short. In fact, I first started getting long Mobileye down here, and you guys can go back to that webinar if you want to, because we actually when we put out the video, I included a note in the email for the link to the video. I pointed out that I had flipped to the long side based on the fact that I could feel this thing was not really getting any selling, and you could feel the bid in it. So you go long, and stocks had to move, and then getting short up in here. But I could feel this as it turned off the lows and started coming back up to like 36.60, 36.70, that there was a persistent bid all of a sudden. And so these days when I feel that, I just cover my position. Sometimes I'll even flip long. So that's what I did. I ended up going long the stock. And then we're getting towards the close, and it's trading like 37.20, so it's almost near the highs again. And I'm thinking, am I going to hold this over the weekend? It's acting pretty well. It looks like it might want to go higher. And I figure, well, if it's going to do anything, I can just jump back on it on Monday. So I sold my 7,500 shares and cashed out, and I get a double scalp, one short, one long, and then Monday morning wake up and it's trading up here at 61 bucks. And so I wasn't sure whether to be really ticked off that I didn't still have my long position, or just be really glad I wasn't still short the thing. So I don't know. What do you suggest, Dr. K, from a therapy point of view? Should I just sort of focus on being happy that I wasn't short the thing into the jack up?
Well, generally speaking, yeah, that's the right description.
You know what it
You know, I
reminded me?
it was like that near miss with Lycos back in '99.
Yeah, when I was short, I was actually short 50,000 Lycos. I don't know if any of you were from that time. That was one of the internet engines or something, I forget. But I was short 50,000 Lycos at around 55, I think it was. And towards the end of the day, like the last hour, I could see, and being short the thing, I could see that somebody was in there just buying it up and pushing it against me. Now, if I had operated back then the way I do now, when I start to feel that on an intraday basis, and maybe I would be using my 620, 5-minute 620 intraday chart to guide me, I might have flipped long on the Lycos at that point. But instead, I stayed short the 50,000 shares, and then after the close, there was news that Telefónica de España was looking at buying them. And so, you know, at that point, I basically burned a hole through my underwear, and the next morning we get up, and the stock's up like $4 or $5, and I'm thinking, okay, I'm just gone. So put an order in to cover the thing, lose $5. And even though it seems like a lot of money, relative to the account size, it wasn't that much. It was maybe like a 5% hit that I took at the time, and I just took it and just got out of the way. And then eventually, a couple, 3 weeks later, the stock was trading at 94. But you know, these days, if I feel that sort of thing, I just flip. I flip, and maybe I'll at least flip out of the short, but I may go long. And in this case with Mobileye, I should have stayed with my long over the weekend. But the way this market is, it seems like a gap up, gap down, fly this way, fly that way type of market with not, you know, without a lot of, even though the indexes keep going high. Somebody says, be glad and grateful you are not short. I am, so I'm trying to focus on that. And whatever, you know, there's always another shot to make a bunch of money somewhere. Although I don't know if it's happening right now. I mean, some of the better moves I've seen is this Clovis, which I think I've talked about before. And this was setting up here along the 10 and 20-day line, bounced off the 50-day on Monday, and boom, broke out. Although if I was long that, I'd probably sell into that. You certainly wouldn't want to be long Biogen. Although that was looking good as of yesterday, you know, almost looking like it wanted to go higher. Was that even, no, didn't quite make it as a pocket pivot, but the thing blew up today. So, you know, that's kind of the way this market rolls. Things look good one day, and they get hammered the other day. And even on the short side, you can make some decent money being short some of these things. Like, here's Lumentum Holdings, breaks down. Let me shrink this so you can actually see the whole picture. This has been a reasonable short over the past few days until a couple days ago. But basically, you got the top of the base here, so it runs up, and then it comes in. Now it's hanging along the 20-day line, and it fails on Friday, so you could have shorted there. Comes in, drops below the highs of this base, and bounces off a region that I'm going to imagine is somewhere off of the 10-week line on the weekly chart. You can see that. So you get this bounce, and then zoom right back to the upside. Is there some news on this thing today? Does anybody know? Seems kind of odd that it's running like this, but now it's jacking back to the upside. So if you shorted it, you would have covered down there along the 10-week line, and then I guess if you're really smart, you would you could have gone long on the bounce off the 10-week line. But that's kind of how, you know, things tend to play out. So look at another one. Delta Airlines is really fun. This one broke down. I mean, I've talked about this many times as a possible pod. You can see the big cup with the handle, and that's a really deep, I mean, that's more than 50% deep, I believe, yes. Is it? Well, it's about that, but 40, 45, something like that. Anyway, so you form this big pod or punch bowl with the handle. Remember, it's not, a punch bowl is not a punch bowl of death or a pod until it fails. And this one became a punch bowl of death here, where it broke down hard on heavy volume, and it looks like it's going to die. But you look at a couple of things, and I think this is why you have to watch very closely. If you're short a stock, it's undercutting a prior low, or even if you're looking to buy a stock that's pulling down and it undercuts the prior low, that might be a better spot to buy than chasing into strength. So what happens is it undercuts this low, just barely, and then it turns back up to the highs. So if you shorted this move, which would have been good for a nice break and probably should have taken the profit once it undercut, then you could have gotten long. But who's going to think that this thing is going to go higher? And then you get this big volume spike here. It looks like it's going to break out again, but it stalls and closes mid-range. And then you can do it one more time here on big volume, okay, and then it stalls out, it fails, and kaboom. Now you break down, and you, let me erase all those drawings so I can see what the heck I'm doing here. And then you undercut this low and this low here, and you turn and rally on huge volume. So this stock, this is another psycho stock. So and there are a lot of psycho stocks in this market. The steels have been that way. X I call a psycho stock. So now it's trying to rally. I've actually shorted it, covered it, and then re-shorted on the bounce again. And we'll see if this heads back to lows or if it holds up. But if you look at this on a 620 on X, let's go to X here. Let me clean up, get back to normal mode here. Where's my 620 chart? I know it's hiding in here somewhere. Here we go. But you can see how you basically short it near the opening, boom, it breaks. And then you get the MACD stretch down here, so you cover down there. Now it runs into the 20 period line, you short it again, it breaks down, tests the low and holds on light volume, so you could cover there, and now you get short again along the 20 period, but it looks like it's pushing through. So, but since I've been able to milk this, I got a little cushion in this, I'll probably give it until we get some sort of a 620 buy signal. So, you know, but it's just, you know, it's a trader, and you just trade it back and forth, and that really seems to be all there is in this stock, even though you had a nice move right after the election. If I had any brains, I would have bought the Bible gap up, but you look at the stock and there's really no characteristics of what you would consider a big leader. So I don't know. Would you like the fundamentals of X, Dr. K?
Well, you know, these stuff stocks are betting on the Trump administration's policies going through, you know, so but as a stock itself, you know, that it's all over the place, so definitely not my kind of I would avoid this because it's going to shake you out, most likely.
Yeah, and even if you look at something like Steel Dynamics, you know, I mean, look at the fundamentals on that. You've got a stock with, you know, earnings were up 400% this quarter, up 160 last quarter, and up 164% the quarter before. Sales have been accelerating, up 20% in the most recent quarter, but it also can't get going, and it reverses off the highs today. I probably should have been short this turkey this morning because you're getting better break on it to the downside. But again, you know, there's a lot of these names, and if you look at something like an Oracle's been moving, okay, gapped up today after earnings. Look at Cisco. Cisco's acting pretty well. You look at Microsoft. Microsoft is acting pretty well. You look at Home Depot. Home Depot's acting pretty well. Throw in Apple, acting pretty well. You throw in Google with the L, acting pretty well. But if you look at the earnings on all these stocks, you're looking at single-digit earnings growth at best, and there's really nothing there in terms of fundamentals, but they're pushing higher, and it almost seems to me like, you know, you can throw in your 2 cents here, Dr. K, it almost seems to me like they're using these stocks as sort of an an alternative currency, and they're just buying them because they're big and they're established and they're going to be there, and we're getting ready for something nasty, you know, who knows. But it just seems odd that you're seeing these names doing really well, but the earnings are not there, and you see it all over the place. So, and I'm not talking about Snap, you know, which is kind of interesting. It undercut this prior low, but it tried to hold. I actually bought this yesterday and traded it twice and did make some money on it, but this morning it could not hold the 20, I think it's a 2064 low here of, is this last week? I guess it's last week. So I'm just gone right there, and we'll see if it sets up again anytime soon. But for now, this thing looks just like, you know, do you think this thing has a shot at turning around, Dr. K? Where would you?
Well, we just have to wait and see. You know, that's the beauty of the pocket pivots, especially this type, is that if we do get one, the chances of these IPO pocket pivots working are pretty good, and your upside is quite big, so your time value is quite big.
Yeah, I was thinking maybe it would do something.
It could trade out for a while, you know, before it actually does that. So, you know, just I would just keep an eye on it. You know, it's on my watch list. And anybody else, I mean, good IPOs, I generally would put on my watch list because they could typically pocket pivot before they even, you know, while they're still forming that U pattern, you know, within the U pattern, they can pocket. So you can get a good early entry in it. And as far as those other names, you know, the FANG stocks, those types of tech juggernauts, I think it's a great way for fund managers to hide out and maintain their bogeys. You know, they all have to.
Yeah, that's what it seems like they're doing. They're just tracking.
You
They're
know,
buying these things to get indexed and get their weightings in order to catch up. And most of them seem to be having to play catch up.
yeah, well, it's like the market's being pushed on a string still. You know, it's not the 90s whatsoever. It's not late 2006. It's not, you know, those times when, you know, you just have a lot of a mass confluence of good names moving higher, and not just for a couple days. You know, it's a sustained move. So, you know, it's back to when, you know, if you missed that initial move, you know, you potentially missed out on the entire move. But that was before pocket pivots. If we did get some kind of sustainable move in a number of good names, you know, that brings us back to those times. And again, when I say those times, the market's had lots of these things over the decades. You know, you just have to, things have to be in a better, maybe fundamentally we have to be in a better shape. You know, and what I was saying at the beginning of the broadcast is that that QE effect is a problem, and it's not going to go away. You can't just you know, blink your eyes and make all the debt vanish. So I think market participants know that. That's why it doesn't seem like there's any real sustainable moves. Everything's like day-to-day basis, and Google and Netflix, Apple, all these things, they're being pushed on a string seemingly, so that fund managers can keep up with their bogeys. And so I don't think we're in a clear environment whatsoever. But meanwhile, you know, these types of rallies, you know, look how long this bull market has gone, you know, since 2009. And we have, of course, had some serious corrections on the way up. You know, of course, that's always been the case. In the 90s, in the late 90s, you know, as great as they were, we had some serious corrections that I remember it did come close to wiping some people out. Like the, you know, correction of late 1998 was very nasty for a lot of people. And then I remember the middle of 1999, as great a year as that was, that mid part from about April to October created, well, in my case, and in many other cases I actually know, created the largest drawdown during those months because the markets were very choppy and irregular. You can see that in a weekly pattern. So yeah, right now, just just stay the course, you know, but keep your, you know, always keep your stops. You know, never enter a trade. I think Ed Seykota always, you know, he always told me this, is never enter a trade without knowing exactly your exit point. You know, and this dates all the way back to like 97, because risk management is your first 3 most important rules to investing, as he'd like to say.
Dr. K, here's a question for you. I think the answer strikes me as fairly obvious, but I'll give it to you anyways. Regarding QTNA, if this was 1999, would you have still sold and taken profits today? Well,
Yeah.
if it's today, it could be 1999, so I'm not really sure. The question doesn't make sense to me, but...
Well, I know what they mean, and actually, no, that's the whole point, is that strategy, markets change, so your strategy should change markets. And if this were 1999, or if this was the late 90s, or, you know, 95 was an amazing year, then no, I'd be sitting pretty in this thing. I wouldn't be selling it at all, because it just seems like one of those stocks that are going to go up, you know, an easy 30 to 70% over the next several days. You know, it was that kind of environment. You know, so it's a different environment today, and that's the whole point, is that if you look at our archives, you know, we've been running the site just north of, I think, 7 years now. You'll notice that our guidance has changed in some subtle ways over time, because simply because back in the new, you know, back with 2009, 2010, even 2011, it was a different kind of environment where, you know, you had a little bit more headroom, so that you could buy on strength. But in the last few years, basically since 2013, even maybe 2012, but definitely since 2013, you just can't be buying on strength, because your risk is too high and your failure rate is too great. So buying on weakness, on this, you know, low volume pullbacks, all those techniques work fantastic in this kind of environment. And you know, maybe we'll get back to a stronger environment where we have more names that actually follow through for not just a couple days, but perhaps maybe, you know, a couple weeks or a couple months. And at that point, we would adjust. You know, Gil and I do our own trading. You know, we create our own strategies that work for our trading personality, and that's ultimately what everyone has to do. But you know, obviously, I would be adjusting for such an occurrence if that were to happen, and that would be fantastic. You know, it has been really since 2003. That was really the last year that the markets had a really good run. That lasted more than, let's see, 2006 lasted for about 3 months, and 2003 was about, what was that, about March all the way out to about, I think, October. The market had a fantastic run, along with many great stocks. So, we're looking at 14 years. It's been 14 years since we had, something that lasted more than 3 months. So maybe we're due after the great correction.
I don't think it can happen. I think the system is so screwed up, and there's so much sloshing around and no real accumulation of stocks, and all the secular flow of money into the stock market, I think, is non-existent. So I don't see the 90s or the 80s or the whole post-war environment returning anytime soon. So personally, though, we'll see what happens. I think it's wishful thinking. I mean, it's a nice thought, but I don't think it's going to happen.
Yeah, well, that's why I always say after the great correction, then at least the markets hit the reset button, and then we have a chance to maybe set up again.
Yeah.
Because the market likes to set up. It's set up many times. In the 20s, obviously, is a classic example. But I think we have to clean out the whole system. We have to really hit that reset button in the form of a major market crash of some sort.
Scrub the decks down.
That exceeds 50%.
Anyways, somebody's asking. We got some questions. Entered. I saw the Integris. I don't know what we're supposed to tell you about it. If you saw the pocket pivot the other day, then you could have bought the pullback to the 10-day line. So at this point, it's trying to make new highs. So Coherent. This is the one we put on here on the gap. Was it the gap move or here? Yeah, on the gap move to the upside. It was announced that these guys are being added to the S&P 500, which is usually good for a few points. And so far it's working, but now you're up at the highs. So. But it's acting pretty well. This has good numbers too. The only thing with all these semis that have been running is that what you'll see is that they have a big increase in earnings coming in this year, and then in 2018 it all seems to dry up. So you're seeing a lot of semiconductors running on that basis, and AMD has been one, but that's kind of dying. Somebody tweeted to me on Monday that this was a solid viable gap up, and I looked at it and I just had to say, you have no clue what a viable gap up is, but that's proof of the axiom that a little knowledge is a dangerous thing. People see something about a viable gap up, and then everything becomes a viable gap up, and they're not really paying attention to the details. But that's one name that has tried to act well. AMAT, there's another one. Micron, that's another one. Whoops. And you can almost buy any of these, or just buy the stocks. M-Chip has been going higher. Lame Research has been going higher. Cavium is another one that's been moving higher. Then you get things like 2.6, which is what it's called. This looks really hot, and then kaboom, it blows up. So you always have that factor coming into play here with a lot of these. So a lot of these chips, or semis rather, they're semi-sweet chips, I guess. They're moving up at their earnings. You see the growth in the earnings in 2017, but then it all seems to slack off. So you sort of wonder how much upside is in these things. So tracking the X here, since I do still have a position short. Remember I told you I'm looking for a clean. I'll cover on a clean 620 buy. Since I've already milked it short, cover, short again, cover, short again up here, and it's gone a little past me, but not by very much, 15 cents or so. I'd also keep a really close eye on the financials. Here's one I shorted this morning. JP Morgan, we can see that it quickly had a 620 sell signal up here early in the day, because yesterday the Fed raised interest rates, and of course that was what everybody expected. And it is viewed that, or it's, people believe that, well, higher interest rates supposedly are good for financials, for banks, and they make money off the spreads, and I guess that helps. So they've all been rallying, and they've been a mainstay of the market rally since the election. And yesterday a lot of them stalled, like Goldman Sachs flipped to the downside on an increase in volume. You even saw the one that we have on the focus list is Ions, Bancorp, starting to look like it might fail here because it reversed back through the 20-day exponential moving average yesterday on pretty good volume. So it's sitting at the 50-day right on top of the base, so it's kind of at a point of no return. So what I would suggest is keeping a very close eye on the financials, because if you see them start to break down, then that's telling you that maybe the Fed really isn't going to raise rates all that much, even though they're talking about 3 more this year and then 3 next year. And it's really, to me, it's fascinating to watch Janet Yellen talk or listen to her talk, because they're so confident and matter-of-fact about how they're going to engineer this soft landing that Dr. K pointed out they've never really been able to do in the past. And with all of this liquidity they've pumped into the system, and with the, what, 2 trillion, 3 trillion, what is the size of their balance sheet now? Anybody know? You know, how are they going to unwind all that? And they've never had to do anything like that before, yet they seem to be so confident that they're going to pull it off without a hitch. And the process we're going through now is well considered and orderly, and they're handling things just the way, just right. You know, the porridge is not too hot or too cold. They're doing such a great job, and blah, blah, blah. So I don't know. I become skeptical. More questions here. Speaking of semis, do you have opinions on fundies for Corvo? I don't really understand what you're talking about when you have an opinion about fundies for Corvo. Just look at the numbers. You got a 31% increase in earnings this last quarter, 33% sales increase. Last quarter up 6% on an earnings. The quarter before that -1. But what we see here is a company going from 0 to 28% earnings growth over the next year, and that's what's been driving it higher. So, and then everybody's jumping into it. So, you know, I don't have to have an opinion on the fundamentals. You can just read them. So you're seeing a near-term acceleration in earnings and sales. You get a bump in earnings over the next 12 months, and it's trying to trade up on that. So that's about it. Other than that, I just watch the chart. If it's holding the 20-day and the 10-day, it looks like it's okay. So anyways, Dr. K, why are these international emerging markets ETFs doing so well yesterday and today? Well, that would be because those emerging markets are going up, so that would mainly do it. But do you have any sort of brilliant answer for that type of question, Dr. K? Vanguard, FTSE, developed market?
Well, they've been dragging along. You know, they got hurt worse than you know, the first world economies, and it's probably just a catch-up effect that they're you know, they're making maybe some sort of catch-up comeback. That's why maybe over the near term they've been outperforming the others. You know, that's not terribly surprising. You know, globally speaking, when things are starting to turn better for the first world countries, that, you know, the emerging countries can definitely outperform first world countries. So maybe there's that expectation that things are turning around, you know, here in the U.S. and also abroad in, you know, countries like, you know, European countries and in the UK. Although that evidence is very scant. Again, it's questionable evidence at best. But perception, you know, keep in mind, perception plays a big role. You know, even if perception's wrong. You know, look at all the dot-coms with no earnings that went up, you know, 500%. They're going up on air. You know, they're no business being that expensive, and eventually they all crashed out. You know, the ones without any real fundamentals behind them. So perception can guide price plenty of times. You know, even if it's wrong.
Someone is asking also about MRVL. That's another semiconductor. Okay, look at this, tries to break out, but it's a similar situation. You got a big bump this year or the next 12 months, and then it all slows down. So it tries to break out and then reverses. So, you know, am I going to tell you need to buy this? This is what it looks like on a weekly chart, so not really. Anyways, let's see. I think NetEase is looking like it's got some problems here. It's I remember I pointed this out last week. It looks like a fractal head and shoulders. You know, this is called fun with pens here. You just draw on this and you can see, look at that. It's a fractal head and shoulder. Now it's starting to break down through the 20-day moving average. Yesterday it dropped below by a dime and closed a dime lower, and actually dropped more than that, but it closed a dime lower. And now it looks like it's heading for this low. So it's got to hold this low. But, you know, again, a Bible gap up, breaks out, everybody sees it, and it fails. Wouldn't surprise me. And that's why this market is just such a pain. You know, there's so much of this kind of stuff that goes on. And this becomes kind of obvious because it's a breakout. The place to be buying this was probably down here on the pocket pivots near the 50-day line and even the 10 and 20-day line. So that's where I would be buying it. Like Momo, that was one I was buying down here around 18.19, and sold it too soon. But after earnings, it had the gap up. You could have bought it. Now it's going to higher highs, and I wouldn't be buying it here, but it's acting pretty well. But, you know, if you're buying it up here, it's very erratic and tough to say. If you're buying it down here, it's a little more orderly. You buy the pullbacks every time it shows some strength, and it acts pretty well. And that was the case with Weibo as well, which is trying to get back above the 20-day line. But this could just be a short here. So you'd watch, you see on the 620 here, you're starting to roll. So I don't know. I wouldn't be buying it just at this point. It looks to me like it's probably just a shortable move. U.S. dollar's been weakening past 2 weeks. Maybe this helps. It helps what? The market? Yes and no, I suppose. I don't really base the U.S. dollar movement or you base the market, my market projections are what I'm going to buy or sell or short at any point in time based on what the dollar's doing, so it doesn't really matter. But it could help, you know, gold and silver, which are trying to rally. So, and this is kind of interesting. They moved pretty sharply yesterday, even as the Fed is talking about raising rates for the foreseeable future over the next 2 years. But you know, they're stalling out here at the 50-day line. So does this become a short? Maybe. Gold though is above the 50-day line, but it's not up beyond the 200-day line. So I don't know. But these are just kind of choppy and sort of just reactive. But that might be partially due to the dollar dropping. So what else? Bonds are bonds getting whacked today? They're down. They rallied yesterday. Now they're getting pushed to the downside. So it's, you know, very mixed, very tricky market. You know, you get some things that start to move. I was watching this as a long, and look at this thing gapped up this morning, opened up at, this is Salesforce, opened up at 83.95, and now we're trading 83.62, so it hasn't gone anywhere. NVIDIA is another one that's on our short list. This is looking like it might be shortable right here on this push above the 20-day line. I was thinking it could rally to the 50-day, so it's sort of in between the two moving averages right now. I actually did trade it off the 10-day line the other day on Monday when the Mobileye buyout news came out, because I figured that would work. But I sold it this morning and actually tested it short once, bagged about 30 cents, went away, and I'm letting it rally now. And it's trying to go, you know, it's moving back to the highs of the day. I think it's a little bit choppy. I mean, on a relative basis, about 1%, but on the chart it looks very volatile. But you can see you're back up at intraday resistance, so it could fail here. So it's possible to test a short and use a high of the day at 103.60, unless it breaks out and goes higher. What's the volume level like this on this one right now, Dutch K? We're up 28, I'm sorry, minus 16%. So it's a weak volume rally. I would say it's probably prone to failure. So I'd just be watching this. And I'll keep it on my 620 chart here and see. But there's a couple of ways to handle this. You can see the MACD cross down along the lows. And it's trying to push higher, but it's not as high as it was back here. So I don't know. It may start to turn. If it went a little further, maybe I'd have to be a little more bold in shorting it. But we'll kind of see what transpires from here. Bob is a real pain in the butt type of stock, but again, here's a show of strength on Monday, and that's a pocket pivot. It stalls out. Looks like it's going to break out, but it stalls out. Pulls back into the 20-day line. You could have bought it there, although it didn't look all that appetizing at that point, because you wonder, it's one time, if it's going to show all these, or given that it's shown all these little bouts of strength in here, and they've all come in, you know, all of these have come in. You wonder if one time it's just going to go boof like that, you know, and straight down to the downside, or not. All right, let's see here. I'm going to test a little NVIDIA here, see if it runs into resistance, but I still think that's in play as a short. So whether it rallies further up to the 50-day line or not remains to be seen. So, but I'm going to stay nimble, and I do that with all my shorts. That's how I didn't get caught being short Mobileye, thankfully. And we'll see what happens. That's starting to come in a little bit. Why don't you guys all knock it down for me? Everybody jump in there on the short side. So Baba code blue today. Well, why are you getting all excited about strength? You know, it was, Baba was looking like, whoops. It was code blue on Monday too. So what? What does that mean? Doesn't tell you anything. My general feeling is that you have to be careful with the over-reliance on indicators because things start to look really bullish and then they don't really pan out. And I've been very wary about jumping into strength. Maybe I'd buy on a pullback, but that doesn't mean anything. It's kind of lost its meaning because every time it's gone code blue, the stock just comes back in. So it doesn't lead to any strength. It's just kind of jerking you around. So kind of meaningless there, Scotty. Somebody says international markets help international ETFs. Yes, that was my point. All those ETFs are up because those markets are up. Yep. Or maybe it's because the moon is in the 7th house and Jupiter has aligned with Mars yet again. Anyways, any more questions in here? No, I don't see anything. I'm in at 103.30. That's nice. So sell it. Let's see. JD hanging along the 10-day line. See, that gapped up today and it's kind of stalling out. So either you bought it at the 10-day line yesterday, or not, or you certainly wouldn't be chasing it here. So it's all just kind of funky and bizarre. Remember, tomorrow we have what, triple witching options expiration, everybody. So things might get a little goofy ahead of that. I'm looking at, let's see, Amgen. See, here's one that's been trending very nicely. Now it just kind of cracks through the 10-day line. You got to be careful with that. Celgene is one that has looked good and bad and good and bad, and it's just kind of trundling along the 10-day line. Maybe it's another one that will break to the downside. But again, things are very choppy, very difficult to deal with. Tesla is an interesting stock. Only Tesla could announce a huge $250 million stock offering along with a $750 million convertible bond offering, all of which is dilutive to shareholders, to earnings, but the stock jacks to the upside. Now, this is something I've considered to be a point of risk with Tesla, but as it turns out, it's not. It actually had a pocket pivot on Tuesday on pretty good volume. There was news that Andrew Left, who I guess is the big Citron Research short seller dude, covered his short in the stock, and he's concerned that it could have some upside on the Mobileye effect or whatever. I don't know. So there it goes. It's turning higher. They're going to price this thing after the close tomorrow. It'll be very interesting to see what happens. Now, generally, when a company announces a convertible bond offering, arbitrage traders will short the stock and then look to buy the convertibles on the offering. And so you'll see a stock come in. So I've never actually seen this happen with a stock where they announce that big of a secondary that's extremely dilutive on a general basis, and the thing rallies. I guess everybody's looking for Tesla to do something amazing here. Either that or this is just a shortable rally. So I guess we'll find out. But it's interesting how this all occurs. So. And that's been on our short sale. So we've had that, NVIDIA. And I would say if you tried shorting it down here, one of the things working against a short was the fact that the volume was light on the break of the 50-day line, and it never undercut this low. So, you know, the chances of it breaking down were there, but you had to cover quickly at the line on the turn. So if you're out, now you'd be watching this. Maybe it rolls over, it becomes shortable again. Maybe it sets up again and goes higher. Hard to say. Stock I think that's shortable in any rallies is Grubhub. I got that one out short today because rally into these lows here. That thing could come all the way down here. I noticed that there's other services out there where, in fact, yesterday we ordered, anybody ever eat at Chicago for ribs? We ordered from there yesterday. And I used an app that was on the Chicago for ribs. Anybody eat there? You guys like it? I think they have great barbecued shrimp. So I don't eat beef, but I'll eat their barbecued shrimp, which are on a skewer. They're pretty good. And they make great baked beans, so if you like that kind of stuff. But in any case, what I noticed is that you could just use this app, and I'm trying to remember what it was called, to order online. And you can order, you know, on your phone, whatever. And it's not a Grubhub thing. So Grubhub's model is there's a lot of there are no real barriers to entry, so they're undercutting this low. So I would think a rally back up into the lows here is possible, but I'm just kind of testing it because you did get a little bit of a MACD stretch and cross earlier here, so I decided to come after it as it did this little bounce. Now it's working a little bit here, but yeah, nothing huge. And I've been playing this one before. I notice NVIDIA is coming in a little bit. So, this is a two-sided market. You can play things long, you play things short, you can play them short and long and then short again, or long and short and long again, depending on, your mood that day or the stock's mood that day. So Square is one that's actually hanging in okay. That looks okay. Acting well along a 10-day line. So it's in a position where it could have a pocket pivot, but we need to exceed this volume here, which is a fair amount of volume. So I doubt if it does that, but it could just continue basing. If you look at it up here on a weekly chart, it's holding pretty tight. So that actually looks pretty constructive. So what else we got here? I'm going to cover some of the focus list names that we have. CC, Shimor, whatever. That moved up yesterday and of course pulling back today. So that's kind of consistent these days for the market. Stocks in the market doing that. Let's see, TTD, this thing has been nuts to the upside. It's finally pulling in. That's a nice move. The only way to buy the stock that was on pullbacks. Viva, doing pretty well. Look at that thing, finally streaking. So it was buyable along the 10, 20-day line after this shakeout. But notice how you don't get any velocity after the big shakeout and pocket pivot. It sells off hard, then it tightens up, and then it goes. Now you're way up there. You're breaking out to new highs, so probably a sell here. I don't know. And then, of course, last but not least, this is Zion. I talked about this earlier. It's sort of at a point of no return. I'm watching, like I said, I have a little short out on JP Morgan. Just watching to see how this plays out. You can watch the XLF too, which is just kind of stalling and hovering, churning around up here. Any other questions? This one is sort of hitting my radar because it's pulled back to the 20-day moving, exponential moving average here, which looks pretty constructive. And the volume's running. What's our volume rate at right now, Dr. K?
That one's at plus 41.
Oh, it's plus. I'm showing plus 49. So you got plus 41. You're real time though. I'm delayed just a pinch. So it's trying to find some support there. So I don't know if that becomes a buy point using the 20-day line as a stop. But this has been a leader in the opticals group. But you've seen a lot of these things just kind of blow up recently. Finisar, of course, light. Psychostock, light, back and forth. Fabrinet was another one, and that's just been breaking down. Claro, that one's just all over the place. But these things are just nuts and very difficult to play for a trend. And I would say, Applied Optoelectronics has had the best trend, but that thing's gotten fairly extended. So the question is it going to bounce off the 20-day line and just go right back to the highs? I guess it could. But I think if you buy it here and you didn't buy it anywhere else in the pattern, you're kind of running a little bit late. The other one is ANET, another psycho stock, because this one broke down and looked like death back here on the gap down on news. And it never went lower. Turned around, had some pocket pivots along the 50-day line, I think right here, and then gapped up on earnings and continues to move higher. So you got to love this stuff. I mean, these stocks, they're just all over the place. I don't like Solar Edge. I think I'd just leave it alone. I don't really see the... You had a gap up move here, but it didn't hold. It's just kind of sloppy and not really doing anything. So I don't see this as something I'd want to buy. And the solars in general, First Solar, that started to get going, but that was a short this morning. I saw that this morning. I should have shorted it, but I did not. Spewer, SunPower, same thing, looks like garbage. So I think if you're thinking that Sedge is going to work and the solar's got something going, you're probably living in a state where marijuana has been legalized and you're just getting a sort of a contact buzz from it, because it doesn't look to me like this group has anything going for it right now. So CSIQ, that's maybe the outlier. I think I saw that one acting better, but that's a Chinese name, and that's where it's at on the weekly. So I don't see anything. You're kind of like digging into the dregs of these pullbacks here, and I don't really see it. So
That's Canadian.
But it's Chinese, but it's called Canadian Solar. So I I know this because I owned this way back when in '06, I think '07. But in any case,
It's a Canadian manufacturer, and it's in Ontario, which is in
really?
Canada.
Well,
Yeah.
I always thought it was Chinese owned. Whatever,
No,
it doesn't really matter. Whatever it is, it's still a solar, and they still look like garbage. You
not
like
looking.
solars?
You know, none of these look really interesting. They're not playable yet.
No,
So
they're chopping around, but there's no real. I don't see any compelling theme here. You know, I thought maybe they could. A couple of months ago, I saw them start to come out of here, but they did that back here as well, and nothing's ever really happened. So, I mean, I still like solar. I think it's cool, but it's not really happening. Um,
it's
what do
a
you say
it's a
to
group
you?
definitely.
And
It's a group to
oh,
be
go ahead.
monitored. You know, it's definitely, you know, keep. Well, your screens will show you if this group comes to life, so you don't even have to monitor the group. That's the nice thing about screens. And I think the group certainly will come to life at some point, because last year was the big turning point. It was a tipping point where the amount of energy derived out of solar was greater than coal. So, you know, that's never happened before. So I think you know, the solar area has huge potential, but you know, in the meantime, I'm not gonna waste any energy on it until I start to see, you know, some sort of evidence that the group is coming back to life.
Somebody's saying VIPS is working for me. Yeah, it's up. So, but that's what it looks like. Sell it. You're getting 10% out of it. I'd probably sell it. I don't know. Somebody asked a question. When you say to use a 10 or 20 day as a stop, how much lower percentage-wise do you actually give it? You've previously said you treat the lines as a zone. Well, I treat them as a zone in terms of if I'm looking to buy something, it could dip a little bit below the line. Or if I'm looking to short something, it could rally just above a line. So, you know, that's what I mean when I say that. How the percentage you give it is really just dependent on how much are you willing to lose if it fails. So if you think you want to give it 2% below the line or 3%, you could do that if you're willing to lose that much. But there is no magic percentage, and I think you're suffering from this illusion that there's some magical number that will guarantee that you'll never be shaken out of a stock, which is just not going to happen, period. There will always be instances where you're shaken out of a stock after it hits your stop. But the bottom line is you decide how much you're going to lose, and that's where you keep it. So if you really want to be tight with things, you'd use the line as a stop. You could use 1%, 2%, 3%. You could use 5% if you're comfortable taking that sort of a loss, and that's going to depend on, you know, the size of the position. If I'm running a huge position, I will keep things generally pretty tight, and sometimes it doesn't even have to move below the moving average. All it has to do is look at me funny, and I'll sell it. So, you know, but I would urge you to like erase any idea you might have, and I'm not saying you do or you don't necessarily, but erase any idea you have that a moving average or some percentage below the moving average has some magical mathematical meaning, and it doesn't. It really boils down to one very simple question. How much are you willing to lose if you're wrong? And if you get shaken out, well, under what conditions would you consider re-entering the stock, even if you have to buy it back a little bit or even a lot of bit higher? So, you know, those are really the questions to be asking. But, you know, people have been fooled into believing that there are all sorts of magical methods that can be quantified and without anybody really thinking about anything. I don't think that that's really true. So, and then, you
And
know, within the context of a volatile market, you know, where are you going to, how much you might allow for more volatility. You had something, Dr. K?
yeah, just keep in mind that we've always said this many times. Everything's contextual. So, you know, if in other words, if the market is racing ahead and your stock is not, I would be very tight about, I would keep my stops very tight, in other words, or even dump it for something better. But, you know, it's contextual situation there. Or if the market is very weak, you know, but you believe it's a temporary weakness, it's not going to go into something much more serious, and your stock happens to break below the moving average in question, you might give it a couple percent leeway, you know, because relative to the general market, it's holding up pretty well. So, you know, that's where it gets tricky. You know, it takes a lot of time to develop that kind of thinking and chart eye, you know, that we talked about in one of our books. So, you know, just you got a lot of things to keep track of, basically, and that's why it's important to keep things as simple as you can as well. not get sidetracked by news and misinformation that exists out there, because it can throw you off what you really need to be focused on.
Yeah, just remember, there are no magical numbers. I even would tell you that the O'Neill's, what was it? First it was 7-8% or 6-7, and the idea that you'll never see a leading stock on a breakout go further than that if it's viable. And I would say, yeah, during the the go-go period in the 80s and 90s, but I think that rule is completely not true. And it was probably based on looking at 30 leading stocks from one period, cherry-picked, and determining that rule from a very few or very small statistical sample size, which was typical of a lot of the work that O'Neill did. As far as I saw it, is very cherry-picked. Anyways, that is all that we have. You got anything else, Dr. K?
Yeah, I was going to say that a lot of the rules, like when I read his book, they definitely worked in the 90s, and I think they were geared to the 90s, but then the market's changed, and you got to change and adjust your rules, and you don't want to have any hard, fast percentages. That 7% rule, that was more or less, it was a great rule. It kept one in a lot of stocks, and as we all know, Cancelin was a champ in the 90s, and, and everything. So just the rule really is that everything always changes, so you got to keep on your guard, and you got to, the way to adapt to changing environments is to just keep your eye on things, day to day. And if you don't have the time for that, then you're going to be less quick to react to a changing environment. But we hope to do that. We hope to do that. We do that all the time. I don't think we've missed a market day in ages. So, we're very sensitive to any material changes that might occur in the future.
Okay, well, there you have it. So anyways, that's all we've got. We're looking forward to seeing those of you attending the mini conference and traders dinner on Saturday out here in Marina del Rey, California. It's going to be, we're going to have great weather. It's nice and warm. It's probably, what would you say, 70s, 80s around here along the beach?
70s. It's along the beach.
It's going to be a good time. So we're looking forward to seeing you guys who are going to be showing up there. Scotty, I know you're coming, and I know a few others are coming. It's going to be fun. And on that note, you guys have a great weekend, because we're going to, and we'll catch you next week. Take care.
So long, everyone.